So I am here with Raunaq of Rome, and Rome is one of the, I think, most interesting businesses in and around basically the U.S. housing and housing finance market. And I want to get into the business, but first, can we just start with your background and how you got interested in technology for the U.S. housing market?
Yeah, so about 8 years ago, if you wind back the clock, I started my career in residential real estate at a company called Opendoor. We were, buying and selling houses across the internet. And I actually joined, and about a couple of weeks into joining, we launched a mortgage brokerage. So I became the first loan officer, meaning I actually took everyone's application, I ran their credit scores, and really what I grew to love about that experience was there was the functional challenge of helping line up their personal P&Ls, but what I grew to love was the emotional challenge of helping them cross this chasm of personal dread, as I would call it. Home financing is the most invasive and intimate experience you might ever go through, perhaps even more stressful than getting a divorce. And so I just grew to love it. I thought, it's a huge asset class, you can make a lot of money if you're right about it, and you can really help people in a formative moment that they will remember. So I grew to love home financing, and I thought there was a real opportunity here that resonated with me. I went on to lead that business unit, and then after leaving Opendoor, I joined a company called Cul-de-sac, which is also building multifamily developments in Tempe, Arizona that were entirely car-free, and led product there. And then subsequent to that, I started Rome. Really what resonated with me about Rome was it was a personal challenge, which is 75 million Americans can't afford a home of $300,000. And meanwhile, sellers know that their low rate mortgage has value, but they can't monetize it in any way. And so what this does is it restricts the amount of inventory that comes on the market, and it increases pressure on prices, which means that fewer people can afford a purchase. And I was seeing this problem day to day because I thought that I could afford a $3,000, $3,500 monthly payment. And so I thought, great, I might be able to buy a house for $400 or $450K. And then I ran the calculation again the next month, and all of a sudden I could afford a home of $375K. And then the next month after that, I could afford a home for $325K. So I just felt like I was being suffocated because the number of homes that I could afford were decreasing every week or every month as rates went up. And I thought there must be a better way. So we found Rome.
And so the thesis, I think, to explain it for people that are just less familiar with the housing market, there's obviously this very close relationship, this very kind of symbiotic relationship between rates and what the government does in incentivizing U.S. homeownership and housing affordability. How tight is that relationship? And maybe paint some of the non-obvious metrics around why your rate is such a critical driver of what kind of home you can afford and your likelihood to sell that home at any point in the future.
Yeah, totally. So, one of the things that was illuminative to us beyond the macro data was just hearing individual customers talk about it when we started out. So one of the most formative conversations I had was a conversation with a homeowner who was having an additional child. So he's going from one child family to a two child family. And he found that if he were to move, his payments would now not only increase 20 to 30% as he had budgeted for, but might increase by 300 to 400% because rates had gone from 5.5% to 6.5%. And I thought, this is crazy. Basically this guy is going to put his family on hold because he cannot afford the subsequent mortgage payment. And why? Because the mortgage payment that he is going to make is tightly tethered to the 10-year treasury yield. And at that time, we were going through a period of QT in the US. If you wind back the clock to late 22, early 23, you start to see the effects of QT show up in economic mobility. So the premise for Rome and the thesis was, why can't this tightly coupled relationship between the 10-year treasury yield and economic mobility, or whether or not one chooses to move or have an additional child, all these underlying dynamics that drive one's quality of life is tethered to something that they have no control over. They're unlikely to be the chairman of the Federal Reserve, and yet it has such a prevalent influence. And I think if we wind back the clock, if we're in the year 2300, and all of a sudden we look back at what was happening in 2025, it'll seem ridiculous that we would bet whether or not people would move based on what happened with the treasury yields or a rate that was generally outside of their control. So assumables were simply the first wedge or premise into that insight, which is, why should you have to, stay put or be unable to purchase a home because rates are at 7%? You didn't do anything to get there. Why can't we get you in a home with a 2% rate? So it's just an opening into that premise. But the broader idea I've always been interested in is decoupling the 10-year treasury yield from mobility and giving people the ability to move regardless of what happens with the macro environment. And that, I think, will lead to better outcomes.
It's almost like, in effect, stabilizing the rate,
Yeah.
right? So that it's not just some capricious variable based on when you decide to look for a home, what the rate is, and therefore what you can afford. But one of the things you told me, and I remember this back when I was an angel investor in the company, I think before you had even kind of launched the website, but the scale of mortgage originations during the low rate environment is unprecedented, basically, in US economic history. Can you give some people some perspective around how many mortgages were originated in that low interest rate environment from late 2020 until 2023-ish?
Yeah. So if you think about all of residential real estate as an asset class, it's worth about $20 trillion in the US. About 14 trillion of that asset class has a mortgage on it. Now, about $10 trillion were originated in 20 and 21. So 60% of all US mortgages that exist on a residential real estate home, they came from 20 and 21.
What was the average rate?
So the average rate was about 3%. So about 400 basis points lower than the average rate today as we're speaking about it, which is about 7. So this is a significant dislocation, right? And dislocations not only create opportunities for investors, but also for entrepreneurs, because you can identify ways where people have not yet adjusted to the rate shock. And we can address that. So that was one of the things we thought was shocking, was there was $10 trillion of low rate mortgages that were issued in 20 and 21. And equity is being built in these homes every day, but it was a once in a generation gift that was given to Americans that people intuitively know has value, but they have not found a way to be able to access.
And you can almost think about that as like all American taxpayers are in effect subsidizing those 10 trillion of mortgages in the form of an artificially low rate. It's basically like it effectively, those consumers shorted money and the government subsidized them. Yeah. Is that the right way to think about it?
Yeah, another easy way to think about it is the effect you might feel today of inflation when you complain about the price of eggs is because your mother or brother or cousin may have been able to get a home with a 2% rate.
Right. That's actually probably like the dynamic that no one's actually talking about, which is there are way more insidious effects than from the government having provided in advance to all of those consumers that we're all paying for in the rest of the economy. Yeah. But also assumability, which is the crux of how you basically equalize that, that's not an entirely new concept. Like there's some historical precedent for this as well.
Yeah, so if you think back to 1982 when we had the savings and loan crisis, actually prior to that, all mortgages were assumable. In 82, we introduced in Congress what's came to be known as the Garn-St. Germain Act, which stipulates that homes come with the due on sale clause now. Meaning, when you sell your home, you must also pay off the mortgage. We introduced this clause to be able to bail out the banks who were holding the notes at the time, because it would create an asset liability mismatch if they were lending out money at 2% and or lending out money at 7% and collecting it only at 2%, right? The banks would go under. And so as a result, we introduced this clause. And at the time, the banks were integral to our community fabric because they were largely community bankers. But today, those same people, they don't necessarily dictate whether or not, if you have a bad milling season, are they going to bail you out? So while the times have changed, the policy hasn't. And what I take this to mean is that, last time assumables were popular was in 82 when rates went from 2% to 17%. And at that time,
over what time frame did that happen?
About 24 months. Wow. In the savings and loan crisis of 82.
I think that's a perspective that a lot of people probably don't have because they think that the rate increase we just lived through was, unprecedented in U.S. economic history. But it sounds like it actually had quite a bit of precedent.
Yeah, unfortunately, I think if you're under the age of 40, what you'll find is that you've only lived through a period of QE of rates coming down post 2008. This is the first time where rates have stabilized at 7. But if you zoom back on the Federal Reserve's, interest rate charts over like a 50, 60 year time period, you might find this is pretty normal. So I think that we have no real plan in this country to make housing more affordable if this is the stasis point. And over the prior 24 months, you've seen rates stay the same. Rates were actually higher last week than they were 2 years ago.
Wow. And so as you think about those, that $10 trillion worth of low rate mortgages that's out there, you can almost think about that as an economic gift that the government has given to the economy, right? But it kind of is random and asymmetric in who benefits from it. It's just the consumers that have it. Now, what Rome is trying to do is allow those consumers to basically monetize it in the form of a transfer. But how does that actually happen?
Yeah, so what we would like to be able to do is today we're starting with the FHA and VA homes. So that's about $1.5 trillion of that 10 trillion opportunity. And what we do is we say, okay, look, you have a benefit given to you by federal law, meaning these homes have to be assumable. However, as part of that, all of the equity has to be cashed out. And we were happy to start there because we just wanted to learn from the framework the
and can you
government
just
gave
give
us.
people, what is an FHA loan for people that don't know?
FHA loans and VA loans are government loans. FHA loans are largely given to people who are interested in putting down, say, 3.5%. So if you want to lower your down payment, before we had Fannie and Freddie programs that went down to 3%, largely if you want to lower your down payment, you got a 3.5% FHA loan. It came with what's known as mortgage insurance premium, which is you get charged 55 basis points or something like that based on you putting down less than 10%. So the idea was if you want to put less down upfront on your loan, you can get an FHA loan. VA loans largely were stipulated for veterans. So you've served the country, you come back, and we passed the GI Bill in 45, which gave you the ability as a veteran to purchase your next home with the single best benefit of a VA loan is zero down payment. So you can purchase your next home with zero down because we know you served, you probably weren't stockpiling savings during that time period, and in return, the country will give you the ability to afford a home. And so FHA and VA loans, they're government loans. You got to think back to 81, 82, we thought the entire mortgage system was basically privatized. That's not the case, by the way, anymore. The Treasury Department foots the bill on everybody's mortgage, regardless of whether it's government-backed or privately labeled.
Through other GSEs.
Yeah, through other GSEs. Like, effectively, the Treasury is the backstop for all of this, you know? They're not like, unless you get like a $100 million loan through a private bank, like, effectively, the Treasury is going to backstop your mortgage at this point.
So just the FHA and VA loans, those are the ones that actually have a very clear stipulation around transferability.
Yeah, so they are allowed to be transferable. So we just started there, right? Because you're like, lower the degree of difficulty and brain damage you incur as a team when you're getting started. Just prove that the demand exists, prove that people need the ability to be able to purchase a home with the 2% rate, that you can market it, you can position it, you can give sellers the ability to sell their home and clear it. And now what we're realizing is, wait, there's an even deeper opportunity here, which is building upon the value proposition that matters for buyers around selection. So, the biggest flag that we get from buyers, the biggest reason they don't like Rome today is there's not enough homes because it's only the FHA and VA homes. They want to be able to buy all the homes.
And what percent of homes are FHA?
About 10 to 15%, I would say. And so, it's about 10 to 15%. In some metros, it might be 20, 25%. But in San Francisco, for instance, there's very limited FHA and VA inventory. And we know in San Francisco, even if you make 300, 400K as a couple, you're like 800K short from being able to afford a home. So everyone I know in San Francisco wants to be able to use Rome. In large part because they don't have a down payment crunch. They have a monthly payment crunch, right? They just don't want to contribute a 15K mortgage for the same house that today has a 6K mortgage. So can we get them the ability to get that 6K mortgage? And that's what we're working towards now, which is unlocking all of the other homes. The other
85%.
Correct. And that will be the single biggest wealth transfer that has occurred in this country.
And so how do you go do that?
So we have a couple of ideas. One is we think we can encourage the government to act on this. And if the government doesn't act on it, we can launch the product ourselves. And we're kind of, parallel processing both. So the way we think about it is that we can create a new structure that allows you to be able to transfer your existing conventional loan to a subsequent borrower. In doing so, you can retain a premium by extracting some type of price from the buyer. And from the buyer's perspective, you still get a blended rate inclusive of what the seller is charging you on their equity, as well as what you're putting down towards their 2 or 3% existing rate. So the general premise is if you put down 5%, you can get a blended rate of 5%. Nobody else in America can offer you this today, to put down 5% and get a rate that is 2 percentage points lower than the market rate today.
Got it.
And for the sellers, the problem for them is they can't move because 66% of them have a rate that is 2 percentage points lower than the existing rates in the market. So they're heavily disincentivized from moving because if they do, they decrease their buying power significantly. They might go from their existing 700K home to a home that's 500K.
Yeah.
Why would they do that? But if we can open up enough inventory, what they want is the ability to trade in their home, which is they want to sell their home in LA for 700K and move into a new home in Santa Barbara for $1 million. But they want to be able to do so while keeping the rate the same, so they actually increase their purchasing power. And it reflects that they've gotten income increase over the last 4 or 5 years. So that's where we're opening up.
Got it. And so maybe I think there's a lot of complexity to understanding rates that like the average person doesn't totally get. So maybe to break apart the two angles. The first angle is regulatory, which is maybe what are you guys doing there, and maybe also why is there a compelling case the US government should want this to happen?
Yeah, so we're talking to folks about the ability that they have to encourage the GSEs to make all loans assumable. And so what this means is for the period of 2017 to 2021, when we issued these $10 trillion of mortgages, we can actually allow Fannie and Freddie to encourage assumability. They could charge a pricing adjustment, which is known as like an LLPA, loan level price adjustment. They can attach that to every mortgage assumption. So Fannie and Freddie make some money as they're ready to go public. But the broad strokes of it is, look, you have an opportunity to make housing dramatically more affordable. You don't need to wait to see what happens with the Federal Reserve Chairman or things of that nature. You can today reset rates to 2% and recycle to what was the typical rate in President Trump's first term. And so we think that for a housing affordability perspective, it is the single best non-inflationary measure you could enact today that is within our control, that doesn't require congressional legislation. It can be done by executive action, and it can single-handedly equalize the
this
playing
could be
field.
done by executive action.
Correct. It does not need congressional approval.
And that could be done durably with executive
Correct.
action.
And you only need it for a certain tranche. On a post-fact basis, like thinking about the future, we could pass legislation to strike the due on sale clause overall. But for the next 4 or 5 years, just make it such that the vintage of 2017 to 2021 loans are assumable in President Trump's upcoming term. So over the next 3 years, let those loans be transferable, and you'll single-handedly make it more affordable to own a house in America. It'll cut housing prices by like half.
Wow. And the notion that it's non-inflationary, I think, also is probably not intuitive to people. Why would it be non-inflationary?
Well, it's not inflationary because we already gave away the money. We already issued the debt at 3%.
We're not giving away more money by subsidizing things and lower rates.
Yes. So I think where policymakers tend to put their money is like, let's subsidize new construction. Waste of money. Let's subsidize new permitting. Great. Takes 15 years. People are heavily disincentivized to be able to do that. I think there are very few proposals at scale that can make it more affordable for people to be able to purchase by the end of the year. This is the single highest expected value proposal I think that can exist for policymakers. So as the Senate begins to think about a housing affordability bill, that's something that's top of mind for us, is making sure that people know this is an opportunity that they have to act. And then of course, if they can't act or won't act, then we can do it.
Wow. And I want to get back to how you can do it solo, synthetically. But before we get there, just a quick question on the political economy of who benefits and who loses from that.
Cui bono.
There's a lot of actors in and around the U.S. housing financing market, and I feel like Fifthwall has been a very active investor between Opendoor and Hippo and Doma and all these businesses. And it's actually not obvious and somewhat bizarre, the incentives that some of these institutions have. Can you walk me through all the parties and who would stand to benefit and lose from Rome succeeding at a regulatory level?
Yeah, I mean, even abstract away Rome, obviously I'm self-incentivized to care that Rome wins, but broadly, I think there's an opportunity that should exist for all Americans. If you're stuck at home and you think you shouldn't have a child, or you shouldn't take that new job, or you should stay in a bad relationship, that's really bad for the country regardless of whether or not Rome makes it successfully, right? So on broad strokes, I think the country should pass this regardless of what happens to our company. Now, the way I think about it is, for most of these consumers, the challenge is going to be, how does it work? Is it too good to be true? That's another big issue, which is trusting the system. That's why we would want the government to act, is it just instills that trust because it's done by executive action instead of Rome doing it as a company. And there's ways for Rome to do it in a way that's trustworthy and credible, legitimate and successful. And, I'm excited about that, but I'd love the government to act. So I think, if you think about all the actors in the system, homeowners, going to be very excited to be able to sell their home with their rate included, because they're going to be able to get, we think about 5 to 6% sales premium. So economists ran an independent report of what happens if you have an assumable mortgage and what happens if you don't. They found that basically if you have an assumable mortgage, you can sell your home for 5% more. So homeowners are going to be happy about this, especially if they have a low rate. Now, some proportion of people, if they got the 7% rate, some proportion of people are going to be disincentivized to want that to happen. But again, small minority of the country that has that 7% rate mortgage, right? So you got to think about how can we do the most good for the most people?
What about the banks?
The banks are going to be less incentivized by this because what they want is to be able to issue new mortgages at 7%. Broad strokes, what happens is if you facilitate a mortgage assumption, you get paid $1,800 today. I'm down to make that a higher compensation amount if you can close it faster in a time frame that's comparable. If you think back to 2021, I'm sure you were getting calls being like, Brendan, buy this house today. If you submit an app on Monday, I'll close by Friday. Now, those same people are going to be like, Brendan, if you want to assume this mortgage, it might take me till December.
Right.
How's that possible?
Right.
And it's basically the economics don't work for them, right? So let's increase the comp. Let's make it more accessible for those people to be able to want to facilitate it. And by the way, they're going to get CHRA credits, like Community Housing Reinvestment Act credits, to subsidize it. That'll be good for the banks, actually. Home buyers obviously are going to love it. Agents are going to love it because they're able to do transactions again. So if you think about NAR, which I call the other NRA, it's largely very appreciative of this opportunity.
They want sales velocity.
Yeah, they want sales velocity. Home buyers want lower monthly payments. sellers want the ability to get rid of this asset and be able to extract a premium or at minimum meet the sales price that makes it worth their while. Because right now homeowners are going through a big existential crisis where they're going to have the home listed for 90 days, have like 50 showings, and have the top bid be like 50K below their list. And why? Because no buyer can afford to purchase it with rates where they are. What we see is median family in Atlanta makes 90K a year. With rates at 10%, they can afford a 325, 350K purchase. Median home in Atlanta is 400. So you're out of luck. They're going to offer 350 tops.
And so for the prospective home buyer, it obviously increases affordability. For the prospective home seller, it allows them to transfer an economic asset they didn't know they had or was otherwise not.
But intuitively, they know it's valuable. If you ask people, like, do you think your low rate mortgage has value? Yes, but they don't know how to monetize it. So I think of it as a little bit like we're illuminating something that has unkept potential and allowing you to monetize it, similar to Uber let you with the car.
And so that exchange of value just increases economic mobility and kind of alleviates the stasis that we have in the economy today. I understand why the banks and the kind of, call it the origination superstructure of the economy would be disincentivized to want this unless you increase the incentives for them. But like, who else is on the other side of the equation that like has an incentive in wanting this $10 trillion of mortgages to just stay around? Is it servicers, special servicers?
Servicers are going to like this because it creates revenue retention for them. So mostly servicers have been managed as a cost center, right? But we're encouraging servicers to think about this as revenue retention. Meaning if you collect payments over the next 27 years, you get like, 25, 50 basis points of payment. Why wouldn't you want that money coming in? Do you want it paid off and sent away to somebody else and, for them to no longer be paying Rocket every month for their mortgage, but instead be paying Brendan Wallace's, private servicing company? No. Like, keep that money coming in, you know? And what's more, you get the ability to cross-sell that person. And they're gonna have brand affinity to you. Why? Because you help them afford this home and you help make that transaction seamless. So I think all of the smart servicers need to start thinking about how can I cross-sell against my existing revenue stream and while keeping that revenue stream outstanding, right? So they need to be able to create new opportunities from that monthly payment that comes in. And they aren't doing this today. But I think you create real differentiation and you can create a consumer brand as a servicer. And I think servicers should have a lot more power than they do today.
Yeah.
Most consumers don't even know who their servicer is.
Most consumers, I don't think, know what a servicer is. And so that's why I was curious to just like unpack the whole political economy here. If this is done at a government level, if this is, let's take the other path, the DIY approach. If you're going to do this, you're going to create a synthetic way to replicate the government, allowing the assumability of these mortgages. How does that actually work? So I own a home. I have a rate of 2%, and I want to sell it to you. And you want to buy that home, and you're willing to actually pay a premium, assuming you can assume my mortgage. If that's the case, what happens, and what does Rome do in this synthetic case? Like, what happens from my perspective?
We basically want to make it like a firm for home buying. You click a button, you get the home. And so the way I think of it is like we will orchestrate everything under the hood for the rails of this, like originating the documentation, underwriting this buyer, collecting the payments from the buyer. Like the way this happens today is kind of crazy with seller financing. Like the origination is like, we'll have a napkin contract, And the underwriting is like, the rate is X if you're white, the rate is Y if you're black, the rate is Z if you're Latino. You know? And like that's literally how people underwrite. It's like racial profiling. And the only people who agree to this structure today are largely those where the seller has extreme counterparty leverage over the buyer. Meaning it'll be like the three archetypes of people I found who engage in seller financing before Rome kind of reinvest in it is Uber drivers.
Is all kinds of seller financing illicit today?
No, it's all allowed. It's just privately done. It's not like regulated or judicious or credible or like structured in any given way.
But in that case, the loan stays outstanding.
Yes, the seller continues to make the payments. And then, they're still on the hook for it, but they're going to charge the buyer a premium.
And then what happens to title? Like, who is
title? Stays with the seller.
Title stays with the seller. So it's almost like the buyer is renting it. Title staying with the seller. They have a right to occupy it.
Yeah, it's like a lease option agreement. Is the way to think of it. But like a lease, I'll give you a way to think about this that'll change your framing, which is when you lease a Tesla, it feels very much like your Tesla. Nobody's gonna be like, dude, this is not your Tesla, stop playing, And yet if you lease the option a home, all of a sudden people are like, whoa, is this really your home? And I think that stigma and uncertainty that arises is due to convoluted notions that I think can be remedied with the right.
Well, because we've conjoined the notion of who's on the title with who the borrower is with the requirement to prepay at exit. So basically you have this reset moment every time a home transfers. So from the buyer's perspective, what are they seeing? They're seeing a home and you're doing the kind of the gymnastics of equalizing that payment to something that is now lower than what they would be paying in the open market, therefore justifying the higher price. And then how walk me through that. Like, what is that experience like from the
You
buyer?
got to think, by the way, for the seller today, they're normally getting 95% of what they ask for. So typical sales price is, say they want to list their home for $500K. At most, they're typically getting $475, $480.
Right.
So it's less like, let's start charging egregious prices of like $550, $600. It's more like, let's at least justify why you can get the $500, which is because you are able to transfer that 2.5%, 3% rate to the subsequent buyer.
Got it.
And then Rome's job is to ensure that seller is protected, meaning we will collect the payment from the buyer. We'll disperse it to the original lender. We'll disperse the premium to the seller, and we'll collect a fee for ourselves. So at the transaction time, when it's T equals 0, and you're most stretched as a consumer for cash, we're going to make it free for you to be able to get that home, you know? And then we're just going to collect a payment on a monthly basis, but it won't be out of whack, and you're still going to save $600, $700 a month. And for the buyer, it's going to be a really simple process. It's like, here's a standard origination contract. We're going to help you understand all the terms. We're going to help the seller underwrite the buyer, and we're going to be able to collect the payments. And by the way, we can use AI to do all of this. So we're going to get like 90% gross margin as a company, while ensuring every customer has a standard, judicious, and credible way to be able to process this transaction.
Yeah, it's interesting because it's like, if you think about the Federal Reserve and like the risk-free government rate as kind of being this thing that varies based on things the American consumer has no ability to control. In this model, it's almost as if Rome is like antimatter to that, because you're effectively providing an equalizing rate on both sides of the equation while eliminating for the seller the counterparty risk, which is why these illicit contracts or these kind of kooky contracts exist, in seller financing instances, while basically allowing title to be free and clear to the buyer. It's a really interesting and elegant solution, because it's like the mechanics of how homes transfer is very confusing. Even for someone that I think focuses a lot on the market like myself, I still get sometimes a bit lost as I actually look at the mechanics. And so if successful, whether through a government channel or through a synthetic channel, what does the future of US housing look like 10 years out with a successful Rome?
Yeah, well, I mean, I think the thing we're most excited to talk about is something we haven't even discussed yet, which is the portable mortgage. Okay. So the thing I'm most excited about is, let's say we went to war with the Chinese tomorrow, and all of a sudden rates came down to 2%. The thing I really wanted to launch is, why can't you take your loan with you? Like, let's say you wanted to move from New York to LA. Why shouldn't you be able to port your rate with you? Why shouldn't you be able to be underwritten as a consumer and then have that be expanded to the amount of collateral that you're holding on to? So the idea that we have is that—
So you decouple the collateralization with the home itself.
Yeah, like the thing we're most excited about is just entirely breaking the relationship between the 10-year treasury yield and whether or not you can move. The ultimate manifestation of this would be you can take your rate with you. If you move from LA to New York, you can take your rate, and that way you have far more economic mobility, because you have to worry less about finding a new home, whether or not your purchasing power is increased or decreased in the macro context from what you've done previously. So that's the end state of where we're going, is you don't have to worry about what's happening with the macro events. You can lock in a rate and bring it with you, or you can purchase the home with the seller's rate that is lower.
That might be confusing to a lot of people. Can you explain how that would even work? So like, I have a home, and it's a $500,000 home, and I have a mortgage on that home, and I pay a particular rate on it, and I decide to move. What happens in the daylight between selling that home and buying a new home for the period of time when I own no home? Like, what happens to that mortgage?
So when you own no mortgage, you would be able to basically just think of it as like an insurance.
Or own no home, rather.
If you own no home, then you don't need to take the rate with you.
Right.
But if you want to—
once I say buy a new home in a new location, how do I inherit that old rate and that old mortgage?
We would basically structure it as, we have kind of like a new novel instrument designed to be able to do this, but the idea would be basically you have a time period similar to like a 1031, like say 45 to 180 days, whereby you have to find the next home. So we'll give you some leeway and we can help secure that next home for you, and you'll still be able to get the same rate. Because we're going to time it such that, effectively, we give every borrower 7 to 10 years, depending on what they want, to be able to live in their current home, knowing that they're going to likely move to a new home within that time frame. So it gives you the ability to have some time period between selling your existing home to finding your next home, and take the same rate from your existing home to the new home. There's structures like this that exist today, like the ARM, the adjustable rate mortgage. And we know this is going to be valuable because the only person to have ever done this before 23 years ago was E-Trade. And they made the front page of every headline.
Walk me through that. What happened?
E-Trade launched what's known as the portable mortgage.
Okay.
And they did so for the ability to be able to have cross-sell revenue to their brokerage, because E-Trade is a large brokerage. But they thought about it the wrong way. They were entirely focused on building a real estate wealth management brokerage.
It was all lead gen for that.
It was all lead gen for that. Instead, that could have been the whole company, was offering the portable mortgage. but they had a good idea around it. I just think nobody else has tried it since then because they didn't really understand how to construct the product design in a way that, as you mentioned, is simple enough for most consumers to understand. But the pithy version of the statement that I think breaks through the clutter is something around take your rate with you. That's it. And then we have to orchestrate, all of the complexity under the hood. So we've thought about that for portables. We've thought about that with seller financing and with assumables. So all of it we view as basically how can we make the headline message as simple as possible for a consumer to understand while orchestrating all of the complexity under the hood.
Yeah. And it basically means that from the consumer's perspective in a success case, what's happening at the Fed is irrelevant to them.
Yeah. They don't need to worry about what the economic news of the day is.
Right.
And why should they?
Insofar as it actually impacts their data, the inflows and outflows from their account, assuming they're buying the same valued home wherever they buy it. And so if that's the case, what happens to the economy and why is that a good thing for the economy? Like, explain why that is a net economic benefit for the American consumer and for our economy.
For the American consumer, I think mostly mobility is a boon for the economy, right? Just think about it as like if people, one of the ways you can evaluate if a city or a state or a country is growing is net migration, meaning are more people moving in than they are moving out.
Yeah.
And migration is indicative of whether or not people are able to come to an area for better jobs, for more affordable housing, for better entertainment, lots of reasons people move. But in general, mobility is an undercurrent that allows for people to be able to grow in their lives, to prosper and to develop and to have families and to get better jobs and to find a better relationship. Now, what happens when you don't have mobility? When people feel trapped, when they feel like they can't move out of their current home. Maybe they stay in a bad relationship longer than they would have otherwise intended to. Maybe they don't take a job that's higher paying or in a different field or in a different economic opportunity zone. Maybe they decide not to have kids, So I think there's a lot of underlying dynamics that are really bad when mobility is frozen, and it creates societal decay. For us, the way I think about it is like, can we create mobility, and what will that lead to? If people were free to be able to move regardless of what was happening.
Well, clearly the government recognizes this in the sense that it's the reason they set up the GSEs in the first place. It's like we want Americans to be able to own homes, to create wealth. We want them to be able to move up on the economic ladder and through that mobility to be able to make decisions that are right for their lives. And we basically have built an entire structure at the government level to subsidize this. Yeah. Your point is that subsidization is just happening too asymmetrically, and that endures benefits to some consumers and massive disadvantages to others, and that's unfair. Is that the simplest way of thinking about it?
Yeah, and there's no other way for people to enter into that subsidization today.
Right.
It was basically like locked up and you threw away the key. If you didn't get it in 2021, good luck.
Yeah.
And a lot of people come to us, they're often very grateful, even with their tears in their eyes, because they think of it as like, thank God I didn't miss the last chopper out.
Yeah. And so, when you think about what Rome is looking to solve today, what is the hardest part of what you're working on right now?
The hardest part I work on every single day is taking all of these ideas and making them simple enough to understand in a text message.
Yeah. And how do you do that?
I mean, you just iterate it and iterate it and iterate it and keep talking to people about it in regular sentences and see what resonates and what doesn't resonate. But I'm constantly thinking about how to simplify the message in a way that you can find trustworthy, but is easy enough to pass along. Like I give people this test of like, if you were to tell someone at a bar who's had 3 beers what you're doing, can they go home and relay it to their partner or to their friends or anyone else? Because that's like how life is, for word of mouth. It's like, it's crowded, people don't remember, it's hot, they're like distracted. Can they remember what you were saying? And can it pass the bar test? If they can't, maybe you're onto something.
And what's interesting, I think, about housing is that housing is also this very personal, very intimate thing. I mean, obviously, as we just mentioned, the government has a strong incentive to want it. Like, homes are where we create the personal economy. It's where we create families. A lot of good stuff happens in homes. Yeah. We want people to own them, and we want people to be able to afford them. And yet it's this extremely convoluted, somewhat anachronistic process in buying them that forces the consumer to confront this very complicated rate architecture and mortgage architecture that they're poorly equipped to understand. And obviously there's been institutions like the CFPB that have emerged to protect kind of, nefarious actors from exploiting that. But it sounds like what your vision is to make it so that there is a subsidy from the government to the consumer in the form of a mortgage, basically. And I'm oversimplifying and saying from the government, but call it from
Yeah.
the lender ecosystem, which includes the government and banks, to the consumer that encourages the very thing we want, which is home ownership and economic mobility. Yeah. Is that, at a very essential level, what Rome is driving?
Yeah, I mean, I just think you should have economic mobility and the freedom to move regardless of what happens in the macro environment.
Right.
You know? Like, I think it's a fallacy that you need to worry about whether rates are going up or rates are going down, and home sales are going up or home sales are going down, and reading the tea leaves of whether or not prices will go up. All that stuff is a distraction from what really matters in life, which is the ability to pursue the things that matter most to you, your relationships, your jobs, your family, things of that nature. You should be able to pursue, I think, untethered from what happens with monetary policy in the US.
Yeah, and you've probably done a full, diagnostic on like what happens to the American consumer when they're confronting a home ownership decision, right?
Yeah.
They're looking at a home they want to buy and they want to get a mortgage.
Well, today they just won't,
They just won't, exactly.
Yeah, 75 million people can't afford a $300K home.
But when you think about that very personal decision, what are the aspects or the elements or like the contours of it that like don't immediately come to mind for someone who's in a venture capital position or an entrepreneur position? Like, what is the consumer thinking about in that purchase decision that's very instructive for how you build Rome?
Yeah, actually something that I was wrong about initially when we started the company is we thought about what are the pillars that are really going to matter for home buyers. And I thought it would be number one, lower cost, number two, simplicity, and number three, selection. And
that was your ingoing assumption.
Yeah, ingoing assumption. Now something I've changed my mind around is actually the thing that matters most for most buyers is selection. And the reason why is because people are looking for a home that they love. We always say, buying is romance, selling is finance. So the way to fall in love is to maximize the number of people you can see. And what we find from that process is if we can maximize the amount of inventory buyers can select from, we maximize the odds that they're going to find a home that they fall in love with. And then from there, cost matters, but it's in such a way that they can meet that criteria, And what that means is we found people now over the years that are willing to like call their father-in-law and be like, hey, Mr. Jones, can you give me an extra $50K? So
because they're so in love with one idiosyncratic home.
Buying is romance and selling is finance. So it's like, they'll make the numbers work to be able to find the home that they love. So that's why it's top of mind for us to increase selection to meet the buyer's constraints around, hey, I want to be able to see all of the homes. And that would really be meaningful to me. But we thought originally, and some proportion of people will do this, like they'll buy the house that they think is the best value. But we think it can be around selection and still be able to meet the functional criteria, But people really are looking to fall in love with the home. And that's something that wasn't as illuminative to us when we started the company.
So people might look at Rome and think this is just a mortgage assumption company. But that simplicity kind of belies what you actually do, which is what you actually do is something almost more philosophical. What is that, and what would a competitor not understand about your business that you're willing to share?
Yeah, I mean, I think something that I thought was funny is like when we launched the company, a bunch of people were like, I was working on this idea too, or like then you see a bunch of clones launch. And I like didn't tell people this, but I was like, guys, if all I care about was Assumable Mortgages, I would just name the company like AssumableMortgage.com. Right. It would have been way better for SEO and like less of a pain in the ass for me to handle. I didn't actually care about that, Like it was just like an entry point for us to solve the broader issue of like decoupling treasury yields from economic mobility. But something that I think people don't understand is like, that's the mission that we're after, is less about like facilitating the mortgage assumption program. So that I think is fine. It's like an entry point and it becomes competitive. And anytime you do something in life that people find compelling, you'll find like 6 other guys pop up and be like, I also think this is interesting. And that's okay. It's like, I think people cloning you is a natural part of life. For us, we think over time, like the moat becomes securing distribution and securing corner resources with being able to actually get these closed in a timely manner. And then actually the ultimate moat ends up being latent supply and being able to pull people who are homeowners that haven't yet listed onto the market because we can help them get a better price in a way where then we can attach the agent, we can then attach the buyer, we can attach the agent for that buyer, we can own the entire real estate ecosystem because we can uniquely help people validate an intuition they already hold, which is my low rate mortgage has value and nobody else is helping me capture that. We can own the supply, we can own the demand. If we can own the demand, we can get more people to come on. So we've seen this in practice, which is a seller that lists their home with the Rome benefits included in the listing description will add an additional 3 to 4 buyers, which will get additional supply to come online, also advertise Rome. So that's like a natural network effect we see of the ecosystem. And we expect there to be clones, but over time, if we maximize selection, we make it as simple as possible for people to be able to purchase, and we can do it in a way that's fast and affordable, like I think we'll win.
And obviously, the reason I imagine you started with mortgages is that big. It's the biggest financing market out there. It's very complicated. It's extremely intimate. And it's the thing that the government really subsidizes because they want mobility in and around it. Does it stop with mortgages? Does it extend to other financial products that you'd ultimately like to go into in the future?
I mean, I think there's lots of things in commercial that are really interesting, you know, but I just want to start with one thing and lower the degree of difficulty and master that. But I also think that residential real estate has kind of near and dear hole to me, which is, you know, if you look at, we both live in New York City. If you look at like, why did Zoran become mayor? I think, or like, why does 60% of Gen Z support socialism? In large part, I think you can draw it to the effect that, you know, the way that people built a stake in the capitalist system was through homeownership or through equities. But 90% of stocks are held by the wealthiest 10% of Americans. You know, like most people don't have significant stock holdings or they don't have a job that they get rewarded in equity ownership. So they don't really feel part of that. And on home ownership, if you don't feel like you'll ever be able to own a home, why not turn over the table? You know, you're not really part of the capitalist economy. You're maybe wanting a new chance. And so I think if we can make it more affordable to be able to own a home, we'll find that there are more things that bind us than divide us. And part of the reason there's so much division today is because that chasm is so far to cross. You know, like most people don't realize that you could be part of the capitalist economy. And that home ownership is a way that most people built a stake in it. That's why we had the GI Bill in 45 and why we have the FHA. And it's been an ingrained part of like what makes it cohesive to live in the US.
Yeah, economic mobility is the economic underpinning of what, you know, makes capitalism work. Totally. And I think both in theory and in practice. And I guess when you hear criticisms of why this shouldn't exist, what do people misunderstand about why this adds so much value to the economy?
Yeah, I mean, I think of it as like, you know, a lot of people underestimate the value of a service that can reduce the complexity of coordinating something. Meaning,
what do you mean by that?
What I mean by that is like you know, you basically, I think, can get paid for two things in life. One is like a technical breakthrough that you can invent mRNA sequencing or the vaccines or, you know, like a technical breakthrough with AI. Or you can reduce the complexity to coordinate something. So one example is, you know, the first people in America to deliver pizza were Papa John's, actually. You know, that was the first service 25 years ago.
I would have thought it's Domino's.
Yeah, but like you call Papa John's and Domino's and you can get it, but now over time you can get Papa John's and Domino's delivered through DoorDash.
Right.
You know, because they reduced the complexity to coordinate a pizza delivery, not only for Papa John's, but for also the consumer. And they're able to absorb the logistics complexity and the operational complexity internally in such a way that it made it far less frictionful for a consumer or for a merchant to offer delivery. And so what I think about is like, yeah, there's lots of ways you can do things without Rome. You know, there's ways people have done seller financing today or mortgage assumptions today, and they could do it with a competitor, or they could do it independently, and they might not use the service. But most of the value in life comes from simplifying it such that people are default on to wanting to do it, you know, and they don't feel like it's so stressful and it's going to take up a large portion of their life and it's going to feel like a second job. So that's our goal, you know, is really reduce the complexity to be able to coordinate that type of transaction in a way that feels magical and frictionless.
Yeah, it's like one of the things that it reminds me of is when we were first investing in Opendoor, which obviously is a company we both know very well. You know, the way I thought about it is this big efficiency rendering solution on this very large, complicated market, because it is effectively a gigantic peer-to-peer market, which doesn't really make that much sense because we've kind of watched economic history cascade from peer-to-peer markets to business to consumer markets. And this is just a consumer to business to consumer market. What did you learn, Opendoor is, what did you learn from Opendoor instructively from that vantage point where like you were looking at this ecosystem that informed what you built at Rome?
Yeah, one thing I found is that like economic liquidity and mobility is a force for good. You know, like the underlying premise was giving sellers liquidity at any price point for a certain rate, you know, and we found
explain why that was good from Opendoor's perspective.
It's good because a lot of the people that were emotional about being able to use Opendoor were people who were like, my grandma just passed away in this home. I really don't have the time or emotional. Yeah, I just want out. You know, and we were able to give them a market where it would actually make economic sense for them. And you're changing people's lives at a formative moment. I think it's like deeply impressionable. You know, prior to Opendoor, I worked at Uber. And at Uber, the market was like, okay, like Brendan might be upset if the driver took a wrong turn. And here it's like, you know, somebody's mom passes away and they need to sell that house. It's like emotionally very intimate, you know, and you're really helping that person in a moment of severe distress. The economics of it actually are pretty lucrative because it's the largest transaction any of us will largely go through, right? So what we find that's instructive there is actually, there is a price that people will pay for the convenience. But I think that is true in environments where rates are lower. So when rates are low, the problem to solve for consumers is convenience. When rates are higher, at least in moderation, the problem to solve is cost, right? And so that's where we started, was actually, we started Rome at a different time period than Opendoor. Opendoor started, 10 years ago.
Low rate environment.
Low rate environment, problem is convenience, right? ZIRP error, just think of it that way. High rate environment, the problem to solve for consumers is cost. Like how can I get the price that I want as a seller? And for a buyer, the problem is like, how can I actually be able to afford? And then they might be willing to actually jump through more hoops, right? So Rome would have been the wrong company to start in a low rate environment. In a high rate environment, you start with the cost end of the spectrum and work your way down to convenience with Portable.
And you've had a really interesting growth story from a financing perspective as well. So walk me through the financing history of Rome from when you started it. What year was it?
We started, 2023, I think. Yeah.
I'm trying to remember when that was.
I'm also trying to remember.
I met you on a phone call.
Yeah,
I think
2023.
And we'd never met until probably a few months ago.
Yeah, 2023. So Brendan actually invested prior to us even having a website. We just had like a one-page memo that was like, here are the plot points of the idea. And we were very fortunate that you invested. So we raised like 1.25 million in our first seed round, or pre-seed round rather, which was like just a memo. And then, we launched the company in the Wall Street Journal, which your head of comms at Fifth Wall helped us. And then all of a sudden it was everywhere. And there were like thousands of people. Then you would like wake up in the morning and you would have 3,500 emails, and you would go to bed and get down to 1,600 emails, and you'd wake up and there'd be 6,000 emails.
And so you saw that kind of media relations was really valuable for your business.
Yeah, especially because it added contrast to what was happening in the media at that time. So even now.
It was a counter narrative.
Yeah, like just last week I found out we were in The Economist because somebody texted me to say, did you know you were in The Economist?
Right.
And I didn't even know that was a thing, And so the reason why we do so well with earned media is not because of me. Nobody even knows who I am. It's like largely because we add contrast to what the broader issue is, which is reporters have to always say like, sales went up, sales went down, rates went up, rates went down, in the sense that they're implying to the consumer that they have no agency. And then along comes a solution that they can hear about and they think is interesting. Why? Because it adds agency for the consumer to be able to act, regardless of what they read with economic monitoring reports. And so that's what I like.
So differently, it's hope.
Yeah, it's hope, right? It's like, yeah, man, like you can actually afford a home. Don't worry, you didn't miss the last chopper out of Saigon,
Yeah.
And so I think that's what I like about the company and why I'm excited every day is like, it gives people a hope and optimism that there is a better future that they can build towards, and they don't need to put their lives on hold to be able to access that.
And then who was the most recent round?
Most recent round, we also raised $11.5 million from Khosla Ventures and Founders Fund. So, we've been fortunate where Keith, who's our board member and lead investor, has kind of tripled down with the company every single time there was an investment opportunity. He took it, and so we're grateful for that relationship from Founders Fund and from Khosla Ventures now.
Yeah, and Keith's obviously incredibly prescient on what's going to happen in U.S. housing markets and has a lot of experience around it. Well, look, I just think what you're building is so fascinating. I've been, and Fifth Wall has been long fascinated with the U.S. housing market. It's such an important part of our economy, and it's something that's very easily misunderstood by politicians, by the consumer, even by investors. And I fundamentally believe in what you're building, and I'm rooting for you to equalize rates so that we can have more economic mobility in this country. And I want Rome to be super successful. So thanks for unpacking, everything that you're doing, and love what's going on.
Thanks for having me.
Of course.